Well, CNBC has a new financial wellness and education initiative called Invest in You. Ready, set, grow. As part of our partnership with Acorns, the micro-investing application. April is Financial Literacy Month. Today is Tax Day, of course, and according to a new survey from Janus Henderson, a lot of taxpayers were very surprised when they filed this year. Joining me now is Matthew Sommer, Vice President and Director of Retirement Strategy at Janus Capital Group. Thank you so much, Matt, for joining us. Were a lot of us shocked because of how much we may be owed this time?
Good morning, Dom, and thank you very much for having us this morning. Yes, we conducted a survey just a few weeks ago, and we found that households with income above $100,000 are very disappointed with their 2018 tax situation, and really there are two reasons for that. The first, of course, is back in 2018, the IRS adjusted the withholding, and so people received more money in their paychecks and probably didn't know that. And so when they settled up at this time of year for their 2018 liability or refund, whatever the case may be, it wasn't what they had expected. That said, there are some taxpayers who predominantly live on the coasts, whether it be California or the corridor between Washington, D.C. and Boston, who are really being impacted by the $10,000 limit on state and property taxes, regardless of whether or not they file a joint or single return.
All right, so what lessons can we take? Because I know what lessons I'm going to take out of this. I am one of those folks who was under withheld this time around, so I had a bit of a tax bill. What exactly are the takeaways for many taxpayers and investors out there learning the lessons that we did from tax year 2018?
The most immediate thing to do is to adjust your withholding with your employer. And one of the more surprising results of our survey is 20% of respondents did not hear from their CPA and 40% did not hear from their financial planner about what action to take relative to the new tax law. So the very first thing that we would suggest is if you work with a paid professional to get assistance and to update your withholding with your employer, so that way you minimize the probability of having surprises this time next year.
All right, so one last thing before we let you go. This idea now that we have taxes already due today, what exactly can investors do to maximize their particular approach to taxes next year?
So for 2019, there are a couple of strategies that still make sense moving forward. First, you can still itemize charitable deductions. However, in order to take advantage of a charitable deduction, you need to itemize. So you need to make sure that you bunch your charitable deductions in such a way so that your itemized deductions exceed your standard deductions.
Gotcha.
Health savings accounts still remain a great opportunity, and I know we talk about it every year, but 401ks and IRAs are still one of the best things that you can do,
Gotcha.
both tax-wise and savings-wise.